Hello guys, how are you? Okay, so as promised, I think it is time that we do talk about the strategy that we're going to be using in the market. I'm sure most of us have also devoted time for ourselves to understand the whole nature of this business. And with the resources that we have provided, one can easily start off, of course, including this strategy that we're about to give. You can actually use these prescribed methods to actually start off with the market for the year. All right. So it means that you should have understood the principles that we have been discussing from the beginning. Um, I'm assuming that most of us by now understand um, the concepts of candlesticks, how they work, and the candlestick patterns that we have discussed in this course. I'm sure most of us, if you have written them down, you would have probably seen that the engulfing pattern is usually the most common, and it being the most common, it is also usually the most accurate. So most of the times, I would encourage that the trades that you'll be taking in are trades that actually have an engulfing candlestick pattern formation, because that gives more accurate entries. Okay, and then of course I'm sure by now most of us have seen that the 4 hour time frame will probably be the best time frame to trade on. Why? Because it gives you time to really analyze the market before you can get into trades. That's number one. Number two, there is less noise on that time frame. So I would encourage that most of us actually get on to use the H4 or the 4 hour time frame. Okay. Of course, some would want to do multi time frame analysis. It's allowed. You can go to the daily. You can go to the daily. You can go to the weekly to do multi time frame analysis. But for your entries, I would encourage that you use the 4 hour time frame. Okay. So to really dive into it, maybe what I'm just going to do is I'm going to remove these indicators that I have already so that we can start off together. Okay, we did give a video on how you can use MetaTrader 5 on PC, and as you can see, the interface is different from the one on PC. So I'm sure if you're going to be using PC for your trading, just refer to the video that we have given and utilize that video so that you can set up your charts exactly as the ones that we have prescribed in that video. Okay, and most of the indicators that we are going to give are just the same. The strategy can also be set up on PC. You know how to set up your template so that every time you open a new chart, you can easily put in that template and then be able to utilize the strategy as we are going to give it. Okay, so usually for those who are using Apple devices, you might find that MetaTrader 5 might be difficult for you to get. So maybe the PC version MT5 would be the best for you. Okay, so you just make sure that you watch the video on how you use MetaTrader 5 for PC. The concepts of trading are just going to be the same. The platform that you will be trading on is the same. It's only the interface that is going to be different. Okay, so make sure that you understand how the interface on PC works if you are going to be using PC. But it is also very much well that you can use your mobile device. If it is an Android device, MetaTrader 5 is still available on that one. So you can use an Android device. A tablet would be the most recommended gadget to use because it has a bigger screen and you can be able to analyze um, higher time frames on a larger screen. Okay, now we're basically going to start adding our indicators on the chart. Of course, you know that the set of indicators that you are going to be putting in are the ones that are actually going to determine what the strategy is. Okay, so as we all know, indicators are basically a set of signal alerts in the market. Okay, so we are saying indicators are more of statistical information of the market that has been combined together and is being represented graphically. Okay, so we use these indicators to make predictions in the market. When we see them align in a certain way, they give us a certain signal of whether we should be buying a market or we should be selling a market. Okay, so they are more of signals. Okay, indicators are more of signals. The way that indicators are going to be aligning, they indicate that we should act in a certain way in the market. Okay, so every time you hear the word indicator, I don't want to confuse you so much. Every time you hear the word indicator, just understand that it is a set of analyzed ratios and formulas that are being represented to you graphically. Remember, we say technical analysis is the study of the past so that we can be able to predict the future. Okay, so what indicators are going to be coming in and doing is they're going to be aligning in a certain way in the past, and then if we see them aligning the same way in the future, then they are going to be giving us a signal of what we should be doing in the market, whether we should buy or sell a market. Okay, so there are lots and lots of indicators, but I'm just going to show the most important indicators that you should probably look into. Guys, forex is big. There is a lot of information online, but I think it is very imperative that we come in and filter this information so that we can give the relevant information to the beginner, so that you can be able to trade the markets without much hassle. Okay, so remember, people, we have already explored MetaTrader 5. So remember, when you click anywhere on the clear screen, you're going to see this circular bar here. And remember, we said where there is this F symbol here, that is where all of our indicators are going to be. So when you click on that F button, you're going to be taken to this page. When you go on this page, you click on the F plus symbol here. All right, and where the indicator is going to be placed, it's going to be placed on the main chart. That's why it's written main chart. You come and you click F plus. So these indicators are grouped according to market structure or market movement. Okay, market moves in different ways, people. Remember, we said we have trending markets, so these ones are trend indicators. If you're going to be using if you're going to be trading in a trending market, these are the best indicators that you can utilize, of course. So there are lots of indicators, as I have already mentioned, but for our specific strategy, we are going to be employing the moving average. Okay, so when you click on moving average, you're going to see a number of parameters that are written here. So what I want us to do, the first indicator that we are going to be adding to our chart, of course, you're going to come here where it's written period. You're going to put a period of 20, and where it's written method here, you're going to use the simple moving average. And then, of course, the style that we are going to be using, of course, 3 pixels so that it can be visible. And then I think this is how you're going to set up the first indicator that we're going to be putting into our chart. Okay, this is a moving average, a 20 period moving average, and it's going to be red in color. Okay, please, these colors are very important. It's going to be red in color. And then you can simply click here on done. Okay, so when you click on done, you're going to find that on the main chart, a moving average has been added. Okay, so if I click back, when I come to the main chart, there is a red line that is following price. Okay, this red line is following price. It is the moving average that we have added. It is the indicator that we have added. Okay, so Basically, what a moving average is, it is going to be taking the average price or the average rate of the past 20 periods. Okay, that is the reason why when we come to the F symbol here and you click on the moving average, I've clicked on the moving average because this is the one that we have already added. Okay, so you see here it's written 20. That means it is going to be calculating the average price of the previous 20 candlesticks. Okay, of the previous 20 periods. Okay, and it's going to give you the average rate at that specific time. Okay, so at the moment, the average price of the previous 20 periods of USD ZAR on the 4-hour time frame is 17.19345. Okay, so every time that we have a new period, this average price is going to be updating. Okay, so it's going to be updating after every period. Okay, after every period, we then measure the average of the last 20, including the one that is already closed. Okay, people, we only make decisions in the market after the closure of a candlestick. Why? Because we cannot make a trading decision before a candlestick is closed. Because remember, people, there are weeks. We cannot predict how the market is going to end, how a trading session is going to end before the closure of a candlestick. Okay, so it is very important that every time that we want to make a decision in the market, we only make a decision on the closure of the candlesticks. Okay, now that we have added our moving average, our 20 period moving average, this path, this red line is just showing the path of the average 20 period rates that have been calculated by the moving average. Okay, so this moving average is basically calculating the average rate of the previous 20 closures, of the previous 20 candlesticks. Okay, so you're going to be given an average, an average, an average, and this path is going to be connected by a line which is called the moving average. Okay, so this is the moving average. We've added the first indicator to our chart, which is a 20 period moving average. Okay, so now that we have added the 20 period moving average, you're going to click again on the clear screen. We want to add to the main chart again, so you're going to come and click on F plus. We're going to add another moving average. Okay, so this time we're going to add only a 10 period moving average. So this time I'm going to add a 10 period moving average. It has no shift. The method, it's still a simple moving average. And then of course we're going to be applying to close. This is very important, people. We only make trading decisions on closure. So we're going to be applying to close. And then on style here, I'm going to change the color to I'm going to use green for that one. And then of course the rest you leave as is and you click on done. Once you click on done, as you can see now, it says on main chart there are two moving averages. Okay, so when you go to your chart, as you can see now, we have a green moving average, which is a 10 period moving average. Okay, so what we're saying is that this green moving average is going to be calculating the short-term average prices. Why? Because it is a 10 period moving average, and the red one is going to be calculating the long-term average of price. Okay, so the green is going to be calculating for 10 periods, and then the red is going to be calculating for 20 periods. Okay, so every time that you're going to be seeing the green moving average, which is the short-term moving average, above the red moving average, which is the long-term moving average, then it means this market is in an uptrend. Why? Because the average price of the last 10 candlesticks is above the average price of the previous 20. So in the short term, or in recent times, it seems the price is ranging higher. Okay, because the moving average, the green moving average, which is the short term moving average, or the 10 period moving average is above the red moving average, which is the long term moving average, or the 20 period moving average. Okay, so our strategy is going to be made or based on this simple principle. These two moving averages, the green moving average and the red moving average, the 10 period moving average and the 20 period moving average. Okay, this is going to determine whether our market is in an uptrend or is in a downtrend. Okay, people, remember there are two scenarios in the market. It's either you're going to be buying a market or you're going to be selling a market. Okay, so now we have our moving averages on the charts. I just had to change the currency pair here. As you can see, I'm now on odd USD, but I'm still on the 4-hour time frame because I think this is the best time frame to be trading on. And as you can see on this chart, the green moving average is actually below the red moving average, which means the average price of the previous 10 candlesticks is actually lower than the average price of the previous 20 periods. That means in the recent times, this market is actually ranging lower. So this means the green moving average is below the red moving average, which means this market is in a downtrend. Okay, so what determines whether the market is in an uptrend or is in a downtrend is how the green moving average and the red moving average are going to be oriented. Okay, so every time you see the green moving average above the red moving average, then that market is in an uptrend. And every time we see a market in an uptrend, we're going to be looking for what? We're going to be looking for buying opportunities. We don't sell in an uptrend. Okay, it's a cause for disaster, because remember, we said every market is going to be having swings, pullbacks, swings and pullbacks, swings and pullbacks. So if this market is in an uptrend, you don't want to be seen selling this market. Why? Because you end up drowning in losses. Okay, so every time you see an uptrend, we're going to be looking for buying opportunities. Okay, so every time you see the green moving average above the red moving average, then that means that market is in an uptrend and we'll be looking for buying opportunities only. So here is a perfect example of the previous illustration. Let us look at this move right here. Okay, when we come and we look at this move, as you can see, people, the green moving average here is actually above the red moving average, which means this market was in an uptrend at that time. Okay, it being in an uptrend, the opportunities that we are looking for are only buying opportunities. Okay, we only buy in an uptrend. Every time you see the market is in an uptrend, you're only going to be looking for buying opportunities. But we just don't buy at any point. We're just going to be looking at specific entries, the ones that we have already talked about, people, the engulfing pattern, the three marching soldiers, and the morning star or the evening star. Okay, so we are going to be combining market structure and price action. Okay, price action is basically going to be for our trade entries, and then the moving averages are going to be providing the type of market that we are going to be entering to, whether it is in an uptrend or is in a downtrend. Okay, we have just been talking about the uptrend. Let us look at the downtrend scenario. So now this one is just the reciprocal of the above situation, people. We are saying now, every time you see every time that you're going to be seeing the green moving average, this green moving average, people, if every time you see it below the red moving average, then this market is going to be termed a downtrend market. Okay, this market is going to be, we're going to say this market is in a downtrend. Okay, So what determines whether the market is in an uptrend or is in a downtrend is the orientation of your moving averages. Every time you see the green moving average below the red moving average, then that market is in a downtrend, people. Is in a downtrend. So you're going to be looking for sell opportunities. Okay, we never buy in a downtrend. Why? Because we risk getting into retracements and eventually having our accounts wiped out. Okay, so every time you see a downtrend, you only look for selling opportunities, only selling opportunities in a downtrend. Okay, so that is a perfect example of a downtrend. The green moving average is actually below the red moving average. Okay, now people, that we have added our indicators to our chart, and we now know how they are being interpreted in terms of whether they're giving us an uptrend or a downtrend. There is just one more indicator that we need to come in and add on. That one, you're going to come again. You know how to add indicators now. On the F symbol here, of course, these are the ones, the indicators that we already have on our chart. You're going to come and click on the F plus symbol here. And then this time we're going to move all the way down. We're going to look at Bill Williams. Okay, so on Bill Williams, he does have quite some good indicators that you can utilize. But we're just going to come in and click on fractals here. And as you can see, I'm going to select this indicator so that it can be added to my chart. Of course, 4 pixels is okay, and the color is also okay. So I'm just going to click on done. When I click on done, as you can see, there are these blue triangles that have been added to the chart. These are called fractals, people. They're very important because they're going to be determining our levels of supply and demand. Okay, so every time you see them aligned in a certain way like this, they represent that the market has tried to reach a certain level, but every time there is a reversal at a strong supply or demand level, it is marked by a fractal. Okay, so as you can see, these fractals are actually saying that this level here is more of a supply zone. Why? Because every time the market is trying to reach that level, it is being reversed downward. Okay, so this must be a very strong supply zone. Okay, so we're going to be using fractals. We can also use them to actually set our stop loss levels. We are saying that when we are coming in the market, let me just add an object here. I hope most of us can now use MetaTrader 5. If I'm going to come and put a line here, these can actually be levels where you are placing your stop losses, levels where you are anticipating break of structure. Break of structure is basically when we're saying a strong level like this. Let's say the market actually came in and broke that strong level. We're going to be terming that break of structure. Okay, BOS. I'm sure in smart money concepts, this is a very much important principle. Break of market structure. This can be used when we're trading smart money strategies. Okay, so we are going to be actually using these fractals to determine our levels of supply and demand. Okay, now I'm going to be coming into the market. We're just going to do a little bit of some back testing together. We're just going to look at the previous scenarios or market opportunities that have been offered by this strategy. Okay, this is more of us doing back testing, looking at what has happened in the past and then being able to utilize that when we see the same arrangement in the future. Okay, so I'm just going to come in and focus on this area right here. Okay, I'm going to be focusing on this area so that I can do some back testing there. Okay, So the very first thing that you want to be doing when you get into the market is to check direction. Okay, you check the direction. When I'm saying checking direction, you are basically checking whether the market is in an uptrend or is in a downtrend. Okay, so when I'm coming here, if I'm going to be looking at how my indicators were set up, as I can see, of course, there was a crossover here. I'll give an illustration of how we can utilize crossovers, but we're not going to be using the crossover strategy. We want to actually get into the market when the market direction has been confirmed, people. Okay, so the green line now was actually above the red line. Okay, so this means this market was actually in an uptrend. Okay, so in an uptrend, we're going to be looking only for buying opportunities. Okay, we're going to be looking for buying opportunities only in an uptrend. So we're going to be utilizing price action, the three main entry patterns that we said we utilize. As you can see here, there was this pattern here. I'm sure we've talked about this pattern. It's called these were actually the three marching soldiers. Okay, so these three marching soldiers would have given us an entry, a buy entry. Okay, so it is very much dependent on the type of market that you're entering. You cannot enter a sell in an uptrend. So that means every time you see an uptrend, you're only going to be looking for the bullish scenario. Okay, so this is actually the bullish scenario that we are seeing here. These three white soldiers coming in. Okay, these three marching soldiers. Okay, so at the closure of the last session, when the three marching soldiers pattern has actually been confirmed, you cannot enter before the candlestick is closed. Why? Because you are not certain that the candle will close that very same way. What if there is a market reversal in the last hour and you've already entered the market and it is probably coming in to end up as a week? So it is very much important that you wait for candle closure every time. So you'd be coming in and placing your entry at that specific point. Okay, maybe let me just clear off the chart. So as you can see, people, these are the three marching soldiers. What you would have done, of course, you'd be coming in and entering the market at the closure of the last session. Okay, and then of course we said we're going to be using our fractals to set our stop loss levels. So you'd be coming in as well and placing your stop loss just below the last fractal before that move, because remember we said fractals are going to be representing levels of supply and demand. So when you are coming in and you're seeing a fractal there, then that should probably mean that this market is actually coming from a demand level and we should have the market actually pushing up higher. And remember, people, the market direction has also been confirmed by the arrangement of our moving averages. Okay, so now we are actually coming in and seeing the very first scenario that we have looked at. Of course, we are saying that the moving averages are showing us the market direction. The market direction, of course, is an uptrend. So we're going to be looking for the bullish scenario. Okay, we have three different types of entries that we use. Of course, the three marching soldiers, the bullish engulfing, and of course the morning star. All right, so let's look at the opposite scenario. I'm going to focus on this area right here, people. Okay, so I'm just going to circle the area that I want to utilize. Okay, so now when you come in and you look at this scenario here, the very first thing that we do, remember, people, we check the market direction. Okay, it's like you're trying to cross a road, you always check the direction. All right, so you're coming in and you're checking in your direction. Now my green moving average is actually below the red moving average, so that means this market is in a downtrend. Okay, and in a downtrend, I only look for selling opportunities. So what you're going to be doing in the downtrend is you're going to be looking at the behavior of the candlesticks while the market is in the downtrend. Okay, so as you can see here, here there were 3 black crows. Okay, so this is one of our prescribed entry patterns, one of our prescribed entry patterns. Okay, so this is an opportunity for you to actually sell the market. Okay, but you always wait for candle closure. Okay, so the very first thing that we have done is we have identified the market direction, and we know that it is in a downtrend, so we are only looking for selling opportunities. And now we're looking for an entry that is going to be determined by price action. Okay, so now I have seen the 3 black crows, so I'm going to wait for candle closure. Okay, when I wait for candle closure, if it does close as the prescribed pattern, the 3 black crows, I'm going to be executing the trade. I'm going to be pressing the sell button. Okay, when you press the sell button, of course, people, remember, you're always going to be coming in and placing your stop loss. Okay, and your stop loss, we said that is why we are going to be employing the fractals. These are going to show us levels of supply and demand. So we are going to be coming in and placing our stop loss just above the previous fractal. Okay, so when you have placed our fractal, when you've placed our stop loss on the previous fractal, we are basically going to be coming in and leaving the trade to run. Of course, there are various methods that we can use to set take profit levels, which include the Fibonacci expansion. Okay, so we can use the Fibonacci expansion for us to check our take profit levels. Okay, so this is the sell scenario we have done for the buy scenario, and we have done for the sell scenario. It is always imperative that you first of all check the market direction. When you check the market direction, you wait for confirmation, or you wait for the prescribed entry patterns that we have discussed already. And then when you get a certain pattern forming, you have to wait for the candle to close before you can execute the trade. And every time you get into a trade, you're going to be coming in and placing a stop loss. Okay, as your stop loss is going to be just above or just below the previous fractal. Okay, remember, people, we did talk about the Fibonacci. Okay, so I'm just going to illustrate how we can use the Fibonacci, both the retracement tool and the expansion tool, for us to see our retracement levels and our take profit levels, where we're going to be setting our take profit levels. Okay, so here is a market. I'm just going to come in and show how this market was actually behaving. Let me just increase my my pen. I think it's okay. Let me put it in blue and use 3 pixels. Let me see how it looks like now. Okay, so I'm going to use that one, and then you're going to come in. I'm looking at this market just to give an illustration of how we can be able to actually use the Fibonacci tool. Okay, all right, so this is the basic market structure that we have been talking about since day one, people. The markets are going to be moving through swings. We did talk about this, the swings, the retracement, and the swings. We said every time we're getting into a trending market, we want to get at the lowest or at the highest retracement level, so that we can be able to enjoy the whole ride of the swing. Okay, so when you're using the Fibonacci retracement tool, you're going to be coming in. And then, of course, when you want to add an object, you come and you click on the plus sign here. And as you can see, these are all the objects that you can use. And I'm sure you know how to, where you can get these objects when you're using PC as well. So I'm going to go, it's written Fibonacci. I click Fibonacci here, Fibonacci retracement. So you're going to be coming in and clicking at the highest point of the swing, going to the lowest point of the swing. Of course, these fractals are guiding me, this is for the downtrend scenario. Why? Because my indicators, people, look at the indicators. The green line is actually below the red line. So I know, just at the look of things, I know that this market is a downtrend, is in a downtrend. And I'm only looking for selling opportunities. Okay, so here you place your Fibonacci from the highest of the swing to the lowest of the swing. As you can see, there are these levels that have been generated by the market. Okay, the most important levels that we obey, or the levels that we mainly focus on, are the 38% level, the 50% level, and of course the 61% level, the golden level. Okay, so these three levels, the 38%, the 50%, the 61.8%, are going to be respected levels of retracement. We can be looking in to add on positions when the market has retraced to any of these three specific levels. Okay, so that is the Fibonacci retracement tool, how you can use it. Let us look at for a scenario of a market in an uptrend. Okay, so I'm going to come in, I'm doing my back testing here. Maybe let me just change my chart so that I can look for somewhere where I have an uptrend. Okay, I want somewhere where I have a clear uptrend, so that I can be able to illustrate properly. Okay, here we are. This market here, the very first thing that I'm going to do when I get into the market is I'm going to check for the market direction. And of course, the green line here is just above, always it was above the green line was above the red line. So this means that this market was actually in an uptrend. Okay, so it being in an uptrend, I was going to be coming in and looking at specific entry points. Okay, so if these arrows are just for me to show the overall market direction. Okay, you need to understand the overall market direction before you can actually enter into trades. Okay, and we are being aided by our indicators here. Of course, I already know that this market is in an uptrend. Why? Because my moving average, my lower period moving average, which is the green one, is actually higher than the long-term moving average, or the 20-period moving average, which is the red one. Okay, so here I am. What I would do when I'm using the Fibonacci tool, when you click on the Fibonacci tool this time around, you take it from the lowest of the swing to the highest point of the swing, of course being guided by the fractals. And as you can see, here are our three specific levels: the 38%, the 50%, and the 61%. And then you'll be looking to check which of these levels has been respected. And we only enter based on the three price action moves that we have already talked about, the most important price action patterns that we have already talked about: the bullish engulfing, and of course the morning star, and the three white soldiers. For this case, since it is in an uptrend, we'll be looking at the bullish scenario only. Okay, so people, I'm just going to illustrate the importance of why we should obey market direction. Okay, so I'm going to come and look at a certain scenario here. This specific scenario, what I'm doing is called back testing. I'm looking at how the market has reacted in the past, so that I can be able to use these concepts in the future to make future predictions. Okay, so here is a market. What I'm looking at is a market that is actually in an uptrend. And by now, I hope you understand why I'm saying this market is in an uptrend. It's basically because the green moving average, people, is above the red moving average. And what has happened now is that I'm coming in and I'm seeing a bearish engulfing pattern. Now, it is very much important that you ignore these types of patterns. Why? You cannot be entering a sell in an uptrend. Okay, Every time you see the market in an uptrend, you're only going to be looking for buying opportunities. Please, please, people, let us not get into these type of entries. Why? Because we only look for the bullish scenario in an uptrend, and we only look for the bearish scenario in a downtrend. So the very most important principle that we have talked about is you being able to utilize the specific scenario in the specific environment. Okay, it is like you're trying to um, grow tomatoes or grow a certain product in the wrong environment. It will not come to fruit. Okay, so you should be able to really look at your market direction first before you can look for the specific candlestick formation or candlestick pattern. Okay, so this is a bearish engulfing. We will not enter this bearish engulfing. Why? Because the market, the overall direction of the market is actually an uptrend, and we are only looking for the bullish scenario. Okay, as you can see, someone who had entered this one right here, um, someone who had entered this bearish engulfing would have lost money. Why? Because when you say sell, you anticipate the market is going down, but the market actually went up. Why? Because the market was actually in an uptrend. Okay, so it is very important to note the market direction. And before we can execute trades, please, people, let us make sure that we have confirmed the entry. The candle closure has came into our aid to confirm the pattern itself. Okay. I hope we have grasped this strategy, and we have been able to add on all the indicators, and we have also been able to make our charts look exactly as this one. People, remember, the time frame is very important. We have encouraged that we trade on the 4 hour. This is where we are going to be looking for most of our entries. So you find that every time you are going to be coming into the market, the very first thing that you do is to check the market direction. And as you can see for this market here, the green moving average is way still below the red moving average, which means this market is actually in a downtrend. But even though it is in a downtrend, it doesn't mean I should just click on the sell button. I have to wait for the specific candlestick pattern formations that we said we are going to be using as our entry triggers. Okay, that is of course the engulfing, the marching soldiers, and the morning or evening star. Okay, so those three are the ones that are going to determine whether we should execute a trade or not. Every time you see those specific price action patterns and the environment or the market direction also confirming that specific scenario, you should be clicking the buy or the sell button based on the criteria that is being given by your indicators. Okay, so I'm just going to cement your understanding of market direction. I'm going to be clicking different pairs here. Of course, my time frame is the same. The 4 hour time frame is always the best time frame to trade on, people. For this one, of course, this market is in an uptrend. Why? Because the green moving average is actually above the red moving average. Okay, so I'm going to look at another market. Let me check the GBP JPY. Just by mere inspection, this market is also in an uptrend. Why? Because the green moving average is below. Sorry, the green moving average is actually above the red moving average, even though they are quite close together. But you can clearly see that the green moving average is above the red moving average. So we'll be terming this market an uptrend market. Although there are no entries at the moment, we know the overall direction of the market at this specific time. Okay, then of course, when I come in and I look at the USD JPY, this market is in an uptrend. Why? Because the green is above the red. So every time that you're looking for entries in the market, you're going to be selecting certain pairs that have potential entries. Okay, so every time you're going to be coming in, first of all, check the market direction. Of course, I've checked the market direction. This one is in an uptrend. Why? Because the green moving average is above the red moving average. And then, of course, I'll wait for this candle to see how it actually plays out. If it closes as a bullish engulfing candle, then I should be looking on to buy this market. Why? Because I anticipate that the market is going to go higher. Why? Because the trend has been confirmed to be an uptrend, and I can only be looking for buying opportunities in this market. Okay, so the very same principle is being applied when it is in the sell scenario. For example, when you come in and you look at this scenario here, whereby we see this engulfing pattern, this bearish engulfing that happened when the market was actually in a downtrend. And as you can see, people actually went on and took on some good profit. Okay, so this is the strategy that we are going to be using as beginners for the time being. We will keep on sending information on smart money concepts, how we can be able to utilize these. But at the moment, if we grasp market structure and use this moving average strategy, we should be able to have an understanding of how the markets work and utilize these specific indicators and strategies to make consistent profits in the market. Okay. Hello, guys. How are you? Okay, so as promised, I think it is time that we do talk about the strategy that we're going to be using in the market. I'm sure most of us have also devoted time for ourselves to understand the whole nature of this business. And with the resources that we have provided, one can easily start off, of course, including this strategy that we're about to give. You can actually use these prescribed methods to actually start off with the market for the year. All right, so it means that you should have understood the principles that we have been discussing from the beginning. I'm assuming that most of us by now understand the concepts of candlesticks, how they work, and the candlestick patterns that we have discussed in this course. I'm sure most of us, if you have written them down, you would have probably seen that the engulfing pattern is usually the most common, and it being the most common, it is also usually the most accurate. So most of the times, I would encourage that the trades that you'll be taking in are trades that actually have an engulfing candlestick pattern formation, because that gives more accurate entries. Okay, and then of course I'm sure by now most of us have seen that the 4-hour time frame will probably be the best time frame to trade on. Why? Because it gives you time to really analyze the market before you can get into trades. That's number one. Number two, there is less noise on that time frame. So I would encourage that most of us actually get on to use the H4 or the 4-hour time frame. Okay, of course, some would want to do multi-time frame analysis. It's allowed. You can go to the daily, you can go to the weekly to do multi-time frame analysis. But for your entries, I would encourage that you use the 4-hour time frame. Okay, so to really dive into it, maybe what I'm just going to do is I'm going to remove these indicators that I have already, so that we can start off together. Okay,